Last time we discussed savings and investments from the perspective of principles and established that it is scriptural for the believer to save and to invest. Today we're going to be discussing specific types of savings and investments and just providing some bit of guidance to the audience as to each of these specific options. At the very basic level is what you call savings account, a bank savings account. So first, I hope that everyone listening to me is part of the banking system. You need to be. That's very critical for financial inclusion. If you're not part of the banking system, then you're probably not planning to make any wealth, because it's not possible to do so outside of the system, especially if you do not plan to do anything illegitimate, because we're speaking to believers here. So in which case there's no reason for you to be anonymous to the banking system. A savings account is simply an account where you keep some balances and the bank pays you interest on the balance that you've kept, and these balances are still available to you for your own usage. Typically the bank will set certain restrictions as to like how many times you can withdraw from the account in a month to still be able to earn interest, or sometimes there might be minimum balance requirements. But this is a very basic level, and the returns on savings accounts are usually quite low. In our own particular environment, with the high rate of inflation, usually in a savings account the interest that you will earn will be below the inflation rate. So I would only recommend a savings account if your purpose for saving is precautionary. Broadly speaking, motivation for savings can be either precautionary or for income growth or capital growth or whatever. If you're just basically trying to put aside some money that you may need at short notice, and you're not certain as to when, then perhaps a savings account makes sense. So at least while that money is there, you're still earning something on it. But if you're really looking to grow your resources, to grow your funds, then savings account is not the place for you. Then there is what you call the money market, where you can invest in certain instruments. At the basic level, again, you have what you call a fixed deposit, where you can put your funds with a bank or through a fund manager who invest in what we call money market instruments, includes treasury bills and all of that. And usually these are fixed income instruments. So there is a percentage that is guaranteed to you. And the longer, of course, the tenor of the deposit, the higher the interest rate, because that's what is called the normal yield curve on investment. So if you're only prepared to put your money out for 30 days, you shouldn't expect the same rate of return as someone who is prepared to put their money out for 90 days or 180 days. Of course, sometimes depending on how far out you go, it's not necessarily the case that the longer the tenor, then the higher the rate, because the yield curve can be inverted depending on what the projections about the future. Again, you've got to then as first, depending again on your own purpose for saving and how far out you can afford to, depending on your needs. If you only have this little window to put the funds out, but you want to then be able to do much better than you can get on a basic savings account, then fixed deposit it's fine. But typically, again, a fixed deposit, while it will pay better than a savings account, in our own environment may still not pay you even as much as the inflation rate. And whenever you are earning less than the inflation rate on your investment, you're technically speaking losing money. And let me explain this. The latest inflation rate for Nigeria is 17.75%. That was the inflation rate in June. So technically, therefore speaking, any investment you have now that is yielding less than that, you're actually then losing money, because the purchasing power of your money is declining at that rate, whereas what you're earning on it is not growing at a commensurate rate. So you've got to be mindful of this. Moving on from that, we have the capital market. The stock exchange is the common source of opportunity that we have there, where you can buy shares, you can invest in shares in a company. The thing about that is, again, depending on your risk appetite, there are typically two categories of shares that companies can issue. They're what they call ordinary shares, which makes you a co-owner of that business, or preference shares. Preference shares don't give you the full ownership rights in the company, but what preference shares do is they guarantee you a certain level of return. But when you then are an ordinary shareholder, you are a co-owner. So you reap when there are upsides, but when there are downsides, you also go down with it. And so there's no ceiling to how much you can make. But then also there is no floor to how much. Well, the floor to how much you can lose is everything. But when you invest in ordinary shares, you are not just getting an income through the dividend. There is also, potential for capital gain, for growth. So if you bought the shares when the price was 10 naira per share, if at the end of the year you earned a dividend of 1 naira per share, you've basically, your yield, the dividend yield for you is 10%. You put 10 naira, you've earned 1. But that same stock that you bought at 10 naira, maybe the price on the market, on the stock exchange, is now 12 naira. Technically, you've 20%. You've gained 20% on capital growth. If you sold it back on that day, you will get 12 naira. If you add that to the 1 naira dividend that you earned, you've basically made a total of 3 naira, 30% over that 1 year period. But depending again on your objective, it just then collect the dividend and keep your investment and in the market, and it continues to grow. So again, when it comes to the stock market, it's one area where you may be well advised, especially if you're not very savvy in financial and business matters, to go through a stockbroker who can guide you in this. And then we have real estate is another type of investment. Real estate is considered a good store of value. It is often rare for real estate to decline. And real estate is one of the oldest forms of investment that really never goes out of fashion. What changes over time is the approach to investing in real estate. But real estate never really goes out of fashion, and that's why for most of the wealthiest people in the world, they would still have some real estate in their portfolio. Real estate is land, and buildings. That's what it's called. So it's not just about the house that you build, that you live in. You can invest in it for income purposes. And these days, people have got to understand that it's not about building and owning the whole property, the whole house by yourself. You can own a piece of it. You can just, it can be a block of flats in which you own just one flat. Or maybe you don't even own up to a flat, you own part of a flat. The important thing is that you're getting income. And the real estate investment also gives you income in cash in terms of the rental that you receive, but you also then have the capital growth as the value increases. Then you have commodities. You can invest in commodities, whether they're agricultural commodities or commodities like gold, which have also a traded price. You can buy them and hold the stock, and sell later when the price, especially for commodities whose prices fluctuate on a seasonal basis. You can buy in the low season and stock them up and sell in the high season when the prices are high. But you've got to understand this, and you've got to be able to do your costing properly, because even the storage has cost. There's a holding cost, there's an opportunity cost of that money during that period when you're carrying the stock. There is also currency trading that is becoming popular with people, but again, that's a very high risk area. You've got to understand the thing, because while you can make a lot of money, you can also lose a lot of money. And then as it gets, your risk appetite grows and your funds grow, you can dabble into even what we call derivatives trading, where usually there's no underlying assets, but the market operators create all kinds of financial assets and determine what kinds of returns and that may be feasible, and you take this thing. But these are really then at the high end of the risk and investment spectrum.